Was the Knickerbocker Trust Company collapse the cause of the Panic of 1907? Imagine a financial storm brewing in the early 1900s, where one big bank's failure sparks chaos across the entire economy. That's what happened in 1907. The panic shook Wall Street and the whole country. But was the collapse of the Knickerbocker Trust Company the main reason? Let's find out. The panic started with a failed attempt to corner the market on United Copper Company stock in September 1907. Investors and banks that bought into this risky scheme lost a lot of money. Banks like Mercantile National Bank and the National Bank of North America faced big losses because they had invested heavily in the scheme. The Knickerbocker Trust Company was one of the largest trust companies in New York. It was connected, indirectly, to Charles W. Morse, a financier involved in the copper speculation. When the scheme failed, Knickerbocker's financial stability was threatened. The New York Clearing House, a group that helped banks settle transactions, refused to support Knickerbocker unless its president, Charles T. Barney, resigned. This refusal caused depositors to panic. They rushed to withdraw their money, and on October 22, 1907, Knickerbocker suspended operations. This suspension sent shockwaves through the financial world. People lost confidence in banks and trust companies everywhere. The panic spread quickly, with depositors rushing to pull out their funds from other institutions. The interest rate for overnight loans, called call money, skyrocketed from about 9.5% to as high as 100% in just days. This showed how tight credit had become. J.P. Morgan, a powerful banker, stepped in to help. He coordinated emergency funding from other banks to stabilize the market. So, was the collapse of Knickerbocker the main cause? Not exactly. It was the immediate trigger, but the real roots of the panic went deeper. The crisis was fueled by risky investments, over-leveraged banks, and a lack of a central authority to step in during emergencies. The failure of one trust company revealed how fragile the entire system was. It showed that without a central bank to provide emergency support, small failures could turn into a nationwide crisis. The Panic of 1907 taught the country a hard lesson about financial stability. It led to reforms, including the creation of the Federal Reserve System, to help prevent such chaos in the future. So, while the Knickerbocker Trust Company's failure sparked the panic, it was really part of a bigger picture of risky investments, interconnected banks, and no safety net that caused the crisis to spiral out of control.